Welcome to the discussion. Today, we're diving into the world of multi-factor investing strategies, a topic that's gaining significant traction in the investment world. Our guest will shed light on how these strategies can potentially lead to better investment outcomes.
Indeed. The promise of multi-factor investing is compelling, but understanding its nuances is crucial for successful implementation.
Absolutely. Many investors are drawn to the simplicity of single-factor strategies, but as the paper points out, these haven't always delivered market-beating returns recently.
That's right. The allure of a simple solution is strong, but often overlooks the complexities of market dynamics.
So how does a multi-factor approach address these limitations? Let's start with the basics. Can you define what multi-factor investing is and how it differs from traditional approaches?
Multi-factor investing is a systematic approach to portfolio construction that considers multiple factors beyond market capitalization, such as value, profitability, and size. Unlike traditional active management, which relies on individual stock picking and market timing, multi-factor strategies are rule-based and aim to exploit persistent market inefficiencies. Passive investing, on the other hand, simply tracks an index, foregoing the potential for outperformance. Multi-factor investing seeks a middle ground, aiming for market-beating returns through a disciplined, research-driven process.
The paper highlights the academic roots of factor investing. Can you elaborate on its origins and how it has evolved over time?
The field's origins lie in academic research, starting with the Capital Asset Pricing Model, CAPM, in the 1970s and 80s. CAPM explained the market risk premium, but further research identified other factors, like company size, that weren't fully captured by CAPM. This led to the discovery that smaller companies often had higher expected returns. This early research, particularly the work of Jean Fama and Ken French, laid the groundwork for the development of multi-factor models, identifying value, profitability, and momentum as additional key factors. Since then, numerous factors have been proposed, but many lacked practical applicability.
With so many factors, how does one avoid the noise and build a robust multi-factor strategy?
The key is to focus on factors supported by rigorous research and avoid chasing the latest trends. Many investors are tempted by new factors, but without a solid theoretical foundation, their future performance is uncertain. Diversification across complementary factors is also crucial. For example, value and profitability often perform differently, reducing overall portfolio volatility. A well-constructed multi-factor portfolio combines factors that tend to behave differently, creating a more resilient and potentially higher returning portfolio.
The paper emphasizes the importance of discipline in multi-factor investing. Why is this so critical, and what are the potential pitfalls of deviating from a well-defined strategy?
Discipline is paramount. Market fluctuations can tempt investors to abandon their strategy, especially during periods of underperformance. However, changing the approach based on short-term market conditions can be detrimental. Sticking to a well-researched strategy, even during periods of volatility, is essential for capturing long-term returns. Many so-called value funds have strayed from their core mandate, diluting their value focus and underperforming when value premiums rebounded.
The paper mentions diversification as a key element. How does diversification contribute to the success of a multi-factor strategy?
Diversification is crucial. It's often called the only free lunch in finance. By diversifying across multiple factors and assets, you reduce the impact of any single factor's underperformance. This helps capture premiums because we can't predict which specific stocks will perform well on any given day.
How should investors evaluate the performance of fund managers employing multi-factor strategies?
Investors should look beyond short-term returns and focus on the consistency of performance. Consistent outperformance suggests a well-defined and robust process, while inconsistent results may indicate inefficiencies or a lack of a well-defined approach. A holistic assessment encompassing research, portfolio design, and risk management is essential. Does the manager demonstrate a commitment to maximizing returns while minimizing risks?
So in summary, multi-factor investing offers a systematic, research-driven approach to potentially enhance investment outcomes. It requires discipline, diversification, and a thorough evaluation of fund managers.
Precisely. It's not a magic bullet, but a well-constructed multi-factor strategy, implemented with discipline, can offer a compelling alternative to traditional active and passive approaches.
That was a great discussion. Thank you for your insights.